Walk into any major Tier 1 financial institution with an 800 FICO score, a clean payment history, and a decade of credit age, and you are told to expect an immediate, frictionless approval. The personal finance industry has conditioned consumers to believe that this three-digit number is the absolute summit of credit health. But behind the consumer-facing interface, deep within the automated underwriting engines of Chase, Bank of America, and American Express, your FICO score is practically treated as a baseline barrier to entry. It is a sorting mechanism, not an approval trigger. The harsh reality of high-end leverage is that banks do not fund FICO scores. They fund risk profiles. Right now, thousands of applicants with pristine 800 credit scores are being systematically denied for premium credit lines, high-limit business credit, and commercial funding. They are left guessing, staring at automated rejection letters that cite vague internal reasons despite their spotless public reports. This happens because public bureaus only tell half the story. The true decision-making power lies within an invisible layer of the banking ecosystem. To understand why the credit system feels rigged, you have to look at what a credit bureau actually is. Experian, Equifax, and TransUnion are not government agencies. They are private data aggregators. They track historical consumer habits, whether you paid your consumer debts on time, how much of your revolving limit you used last month, and how many times you've applied for new accounts. When a bank pulls your credit, they feed this historical data into a standardized consumer model, typically FICO 8 or FICO 9, but that model is completely static. A traditional FICO score calculates your creditworthiness based on aggregate data that can be up to 30 to 45 days out of date due to statement closing cycles. In a volatile macroeconomic environment, relying on a lagging 30-day-old snapshot is an unacceptable risk for a bank managing billions of dollars in credit exposure. While a consumer is busy optimizing their utilization down to 1% to manipulate their public score upward, the bank's internal systems are running real-time asset liability algorithms. They aren't looking at your score. They are mapping your velocity. This brings us to the core mechanism that determines your actual approval limits, the internal bank risk engine. Every major lender runs a proprietary shadow scoring model that operates completely independently of your public credit score. For example, Chase utilizes an internal scoring matrix that factors in your total deposit relationship velocity, while American Express tracks your internal spending to payback behavior over time to dynamically adjust your no preset limit constraints. If you have a perfect 800 credit score but have no historical deposit relationship with a lender, their internal model assigns you a baseline entry-level tier. Conversely, an applicant with a modest 720 FICO score who has maintained substantial, consistent liquidity within that bank's ecosystem for 5 years will often score drastically higher on the internal scorecard. Why? Because the bank possesses raw, unfiltered data on that applicant's cash flow velocity. They can see exactly when capital enters the account, how long it remains as liquid reserves, and the exact ratio of discretionary spending to fixed overhead. In the eyes of an automated underwriting algorithm, a verified data stream of cash flow is infinitely safer than a pristine credit report built entirely on isolated accounts. The biggest mistake an aspiring borrower can make is playing the credit game by the consumer rules. If you spend your time trying to build an 800 credit score using consumer hacks, you are building an empty shell. You are optimizing a metric that banks only use for preliminary filtering. To unlock significant capital, you must learn to position your profile according to the bank's internal underwriting models. In this masterclass, we are going deep into the mechanical math of synthetic debt-to-income limits and utilization timing. Let's build the 75 execution framework. The reality check continues. When an applicant receives a rejection letter from a major credit card issuer or commercial lender, the most common reason cited is an unfavorable debt-to-income ratio. The immediate reaction from the average consumer is confusion. They look at their personal finances, they know they make a comfortable salary, and they ensure their actual monthly outlays leave plenty of room for savings. They assume the bank must have made an error. What they fail to realize is that automated underwriting systems do not calculate your debt-to-income ratio based on your real-world checkbook. They do not care what you actually pay for your lifestyle. Instead, the algorithm builds what is known as a synthetic DTI. This is a cold, algorithmic estimation of your financial overhead calculated by cross-referencing your public credit report data against unverified demographic assumptions and localized cost of living indexes. When you input your stated gross monthly income, the algorithm immediately applies a regional haircut. It analyzes your zip code, cross-references it with census data, and verifies if your stated income matches the statistical probability for your specific profession and geographic location, adjusting your earning baseline downward to mitigate risk. Once your income is adjusted, the algorithm calculates your monthly debt obligations by scraping your tri-merge credit report. It sums up the minimum monthly payments for auto loans, mortgages, and installment contracts. But here is where the trap snaps shut. The system handles your revolving credit card debt through a predatory estimation formula. The system doesn't care if you pay your balances in full every single month. Instead, the underwriting engine takes your total outstanding statement balances, applies an arbitrary multiplier, typically between 2 and 5%, and assigns that number as your permanent monthly liability. If you are carrying a $20,000 balance on an interest-free card that mistakenly reports to your personal profile, the algorithm automatically adds up to $1,000 a month to your synthetic debt liabilities. The machine divides this inflated debt figure by your baseline regional income. If the resulting percentage crosses a hard programmatic ceiling, typically 40 to 45%, you face an instant automated denial. The system is completely blind to the fact that you have the cash reserves to wipe out that debt in a single day. This structural design flaw creates what we call the utilization time bomb. The vast majority of consumers have been taught to believe that as long as they pay their credit card bill in full by the payment due date listed on their statement, their credit profile is safe. They think their score will reflect a pristine, zero-balance history. This is a massive tactical error that ruins thousands of funding applications every single day. Lenders do not report your account behavior to the credit bureaus on your payment due date. They report your balance data exactly on your statement closing date. Your statement closing date occurs roughly 20 to 25 days before your payment is even due. If you utilize your premium credit lines to fund your business inventory, purchase advertising, or cover major travel expenses throughout the month, and you wait until the due date to clear the balance, you are actively sabotaging your profile. The bank has already swept that massive outstanding balance to Experian, Equifax, and TransUnion. To the rest of the financial system, your utilization rate has spiked to 80 or 90%, triggering a high-risk capital stress flag across all networks. When an automated underwriting algorithm from a different bank pulls your report the following week, it denies your request for new lines, completely blind to your payment habits. To consistently break through these automated barriers, you have to stop managing your credit like a typical consumer. You must stop focusing on superficial hacks and position your entire profile to perfectly align with the rigid parameters of institutional risk models. We are pivoting directly into execution. The exact step-by-step architecture of high-limit credit card stacking sequences and the velocity protocol. The audit continues. When an uneducated borrower decides to scale their access to capital, they make the classic mistake of applying for credit lines organically over time. They apply for a premium card with one issuer, wait a few weeks for the physical card to arrive, and then apply for another line with a second lender. They assume that by spacing out their requests, they are demonstrating a calm, calculated approach to debt accumulation. What they are actually doing is setting off a series of systemic alarms across the credit network. In the eyes of an automated underwriting algorithm, an applicant who repeatedly pulls their credit report month after month is flagged for velocity risk. The machine interprets this behavior as a sign of impending capital distress, a frantic search for emergency funding to plug a leaking cash flow profile. To bypass this algorithmic dragnet and secure major capital limits, professional borrowers deploy a highly synchronized execution sequence known as credit card stacking. This is the strategic art of extracting multiple six-figure credit lines simultaneously. This strategy capitalizes on the systemic delay between when a hard inquiry is pulled and when a new account officially registers on your public profile. To execute a flawless credit card stacking sequence, you must understand the structural mechanics of the inquiry blind spot. When you submit an application to a primary Tier 1 lender like Chase, their automated system executes an instantaneous hard pull on your designated credit bureaus. This inquiry posts to your report within seconds, warning subsequent lenders that you have requested new capital. However, the actual credit card account, the newly approved line of credit with its specific limit and exposure metrics, does not report to your tri-merge file immediately. It typically takes between 30 and 45 days for that new trade line to be formatted, swept, and officially indexed by Experian, Equifax, and TransUnion. This delay creates an invaluable operational window. If you structure an application sequence within a tight, highly optimized multi-hour window, Bank B cannot see the newly approved credit line from Bank A. Their underwriting engine looks at your profile and evaluates your risk metrics as if you haven't taken on a single dollar of new exposure. By exploiting this structural data latency, you can bypass aggregate debt limits and accumulate a massive stacked capital base before the financial system can adjust its risk parameters. The mechanical engine of a successful stack is built entirely on bureau arbitrage. Lenders do not pull randomly from all three credit bureaus for every application. Instead, they operate on highly predictable, regionally dependent routing rules. By meticulously mapping these pulling habits before you initiate an application sequence, you can execute a strategy that completely segments your risk footprint. You can structure a stack where you apply for 3 high-limit cards on the exact same morning, but because Bank A pulls TransUnion, Bank B pulls Experian, and Bank C pulls Equifax, none of the underwriting engines can see the inquiries of their competitors. Each automated system reviews your report in absolute isolation, sees a pristine low-inquiry file, and extends top-tier maximum limit approvals. If you submit those identical applications without mapping the bureau targets, they could all route to Experian, causing automatic denials for excessive recent inquiry velocity. While bureau arbitrage provides the tactical entry point, relationship banking is what guarantees the massive limit sizes. To maximize your internal score, you must establish a continuous flow of capital, what we call deposit liquidity velocity. We take this architecture directly into the commercial sector to build out robust, unreporting business credit lines that hide completely from your personal profile. The audit continues. When an ambitious entrepreneur or investor seeks to scale their operation, they almost always begin by leveraging their personal credit file. They see a premium consumer card offering a $20,000 limit, and they immediately use it to purchase business equipment, fund inventory, or launch marketing campaigns. They assume that as long as the revenue generated pays the monthly bill, their financing strategy is completely sound. What they fail to realize is that they are walking directly into a structural trap engineered to suppress their growth. The consumer credit scoring model is mathematically optimized for a typical, low-velocity consumer profile. It is built to penalize the high-volume cash flows required to run a scalable enterprise. The moment a business expense pushes consumer utilization past 30%, the consumer score collapses, restricting access to further funding. To break free from this limitation, you must learn to completely separate your personal risk profile from your commercial activities. You must build an independent, unreporting business credit asset. Today, we break down the corporate veil, the exact underwriting formulas, reporting rules, and entity positioning strategies used to secure major six-figure commercial lines that remain completely invisible to consumer bureaus. Let's strip away the surface-level misinformation that saturates the personal finance community. The vast majority of retail credit cards marketed as business accounts are a complete illusion. Capital One Spark lines, for example, are notorious for reporting every dollar of your commercial balance data directly to your personal Equifax, Experian, and TransUnion files. True business credit cards and commercial credit lines, such as those issued by Chase, American Express, and Bank of America, operate on a completely separate reporting network. While these lenders require a personal guarantee and execute a preliminary hard pull on your consumer report to evaluate your personal credit management history, the ongoing balance data does not report to your consumer file. This creates a massive structural advantage if your business needs to carry a $50,000 balance on an interest-free promotional card. When financing a large shipment of inventory, that entire balance sits safely behind the corporate veil. To the consumer bureaus, your personal utilization rate remains sitting at a perfect 1 or 2%. Your consumer FICO score stays completely unblemished, allowing you to seamlessly maintain excellent personal credit health while simultaneously deploying massive operational leverage inside your business. This separation of data shifts the entire underwriting paradigm away from standard consumer metrics. When you move away from consumer accounts, you are evaluated by entirely different risk models. Commercial underwriting engines rely heavily on data sets like the Dun & Bradstreet Paydex score or the Experian IntelliScore. A Paydex score is not a calculation of historical debt-to-limit ratios. It is a pure measurement of promptness, a numerical scale from 1 to 100 that calculates one variable. How many days before or after the official invoice due date does your business settle its obligations with vendors? If your business consistently settles its trade accounts early, your corporate profile achieves a top-tier Paydex score of 80 or higher. This indicates an elite, highly liquid cash flow environment to the bank's automated risk engine, unlocking massive high-limit approvals. Because these top-tier business lines do not report to your personal file, you can stack multiple premium corporate accounts back-to-back without damaging your personal credit score. We tie personal bureau arbitrage, relationship velocity, and multi-entity architectures into a master funding system. The audit continues. When you look at the macro layout of institutional capital, you find that the ultimate goal of any sophisticated borrower isn't simply the accumulation of random credit accounts. It is the optimization of global exposure. Capital is not a static measurement. It is a dynamic calculation of how seamlessly you can navigate varying bank parameters, manage your automated data footprint, and command high-limit Tier 1 underwriting approvals. The core failure of the average borrower is looking at credit as a series of isolated personal decisions. They look at a single card, a single inquiry, or a single score calculation. They fail to see that every major financial institution is interconnected through shared data networks, automated clearing fraud detection pools, and internal risk metrics that track your aggregate behavior across the entire financial system. To consistently unlock massive six-figure funding without triggering algorithmic red flags, you must deploy a unified master strategy. In this final chapter, we bring every architectural thread together. We pull back the curtain on the final systemic exposure rules, map out the precise step-by-step sequencing for a clean corporate launch, and give you the definitive playbook to take complete control of the banking underwriting matrix. To consistently force an automated underwriting engine into a maximum limit approval, you must understand exactly how to manipulate the internal bank scorecard variables in your favor before you submit an application. Lenders run a shadow rating system that evaluates relationship depth, liquidity velocity, and profile stability. Relationship depth is calculated by the diversification of your banking products, but liquidity velocity tracks the total volume of funds routed through your accounts month over month. The system calculates a rolling 90-day average of your deposits. If your business regularly routes $50,000 a month in merchant revenue through a commercial checking hub, the underwriting algorithm assigns your profile a top-tier internal liquidity tier. This rating acts as a programmatic cheat code, bypassing standard bureau restrictions for massive limits. Once your relationship banking foundation is seasoned, you can scale your funding limits exponentially by executing a multi-entity stacking sequence. This is the advanced strategy of utilizing multiple distinct corporate structures to extract capital from the exact same institutional lenders without crossing your personal exposure caps. If you build a single business profile under Entity a lender may hit their hard internal maximum exposure limit for that single structure at $100,000, causing automatic denials on further requests. To bypass this ceiling, you establish Entity B, a completely separate corporate structure with its own independent employer identification number, distinct address, and dedicated phone line. Because Entity B is a fresh legal entity, the underwriting engine reviews its application as an entirely new risk profile. By leveraging your same clean personal guarantee across both entities within a tight bureau arbitrage window, you can double your approved limits, securing $100,000 on Entity A and another $100,000 on Entity B. This is how you extract massive institutional scale while keeping your personal profile completely hidden from the consumer bureaus. The credit landscape is undergoing a permanent algorithmic evolution. The old days of manual underwriter reviews are completely over. We are now operating in a hyper-automated system governed by predictive artificial intelligence and machine learning risk models. Understand the architecture, master the internal scoring systems, and remain completely grounded in the underlying data. The reality audit is complete. Thank you for watching.